Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you so much for giving us a few minutes of your time. This week, we've got a couple of points for you. We're going to update you on the state of the housing market, a couple of key perspectives there on a rapidly changing and a rapidly evolving market. And then Andrew, as always, will take a deep dive into technicals and give us an update on to breadth. First things first, we'll start off with housing. What we're seeing here is really an expected development, but one that is reaching a speed and magnitude that represents a pretty speedy turnaround. What we're looking at here is the percentage of listings that are showing prices being dropped. Now, if you'll think back just a few months ago, the stories were all about it being a seller's market, and for every house on the market, seeing several willing buyers jumping over each other to make the deal. Boy, that market has changed around pretty rapidly, and we see a pretty sharp rise in the number of houses that are actually seeing the listed prices being dropped. Now, that is to be expected. Again, a lot of this has to do with interest rates. The good news in all of this is that we're not seeing a rise in the unemployment that is leading to this. Instead, we have to attribute most of it to the fact that interest rates have gone up extremely rapidly. Historically, you would see interest rates go up in steps of 0.25 or 0.5. Maybe at the most. And what we've seen here recently have been a series of a half and 3/4 of a point a couple of times. So that steep, of course, is impacting the housing market and really slowing that down materially as it relates to the portfolio. If we were to take a step back and have a long-term perspective, there are a lot of stocks in the housing sector and the development of houses that we think makes sense for the long term. Temporarily and for the short one, we have definitely reduced exposure to that, partly because it's just a very high risk that this market continues to slow and struggle with that steep rise of interest rates. So something that we'll definitely keep an eye on. We think it represents a great opportunity at some point in the future, but probably when we get closer to the end of the Fed rate hike cycle and when they're ready to cut rates down. The other thing I want to share is I really had no idea of this. Sometimes you see things in a different light. Even though you lived through them. Remember reading about it and kind of understanding it, but sometimes a picture says it way better. So we're looking at two different things here. On the right is the housing market from 2008, and then on the one on the left is the one that we're presently dealing with. And what the colors represent, so yellow is a very mild increase of housing prices, and then the dark purple would indicate a real rapid rise. So what we see is that 2008 that really saw the rapid rise in housing prices. That actually peaked in 2005. My frame of reference for that period is always 2008 because that's when the implications finally rippled through into the financial sector. The home prices and that acceleration was really up until 2005. But that was concentrated in a few areas. Florida and the Southwest, notably Phoenix, Las Vegas, really felt the pressure of that. If you look at it today, it's really much more even spread across the country, meaning that we're basically seeing the United States covered in this rapid increase. So it's more likely we're, as a country, going to experience this slowdown together. Now, a couple of notes of caution. This isn't to say, hey, this could be worse than 2008 or that period. That's not it at all. That period was unique in the fact that we had a nasty recession and a financial panic by thinly capitalized and over-leveraged banks. We don't have that at this point in time, and I guess the jury's out on what the economy will do. However, I think it's notable that this housing market is so widespread and it's hot across the board. Very few geographies to be slowing down here in the near term. So that's the housing market. We want to pivot and take a look at the technical update for the S&P 500. Andrew, if you would guide us through what you've seen in breadth these past couple of weeks.
Yeah, thank you, Adam. So every week, and for me, every day, we want to look at the level of participation of whatever the trend of the market is. And are we seeing more stocks going up or more stocks going down? You've heard me say this if you've been watching the market Carver long enough, numerous times, that when we always remember the stock market truly is a market of individual stocks. We want to know, are the stocks going higher? Are they going lower? At the end of last year, something we spent a lot of time talking about is we had very few stocks that were joining the S&P and making higher highs. This year, as the market's been going lower, we're again kind of flipping that script and seeing how many stocks are expanding new lows across different look back periods. We've now, since June, gotten a little bit of a bounce in equities. Still a pretty volatile environment. We're getting a lot of whipsaws, especially as we record this on Tuesday. We're getting another down move in the markets today. We'll see how we finish out the rest of the week. But as we've gotten a little bit of a bounce, we want to start looking for hopefully some positive signs of expanding bullish breadth, which just means we're seeing more stocks making new highs on various look back periods. So we want to see more 20-day highs, 3-month highs, 6-month highs, and eventually start getting more stocks that are making 1-year highs. And that's what this chart shows here, looking at different periods of time and kind of setting different standards where we have the 52-week, 6-month, 3-month, and 20-day highs. And right now, we don't see a lot of those longer term figures. Right now, for 52-week highs, at the recent peak, the recent high when we got up to about 4,300, we only really had about 4% of stocks that were making new 52-week highs. And for 6 months, we got up about 10%. So if we do see the market strengthen, we see bulls retake control of the U.S. equity market, we want to see these levels get taken out. We want to see more than 4%. We want to see more than 10% of stocks at 6-month highs. We want to see an expanding list of rising trends. And that's what's going to give us a lot of confidence that we do see that the bulls really have taken control and that we can start seeing the market continue to recover. If we don't see that, then that's telling us that the market's being led by very few stocks, similar to what we saw at the end of last year, to where the market may be advancing if it does happen, and we don't have a lot of stocks joining it. That's going to be a worrisome sign for us. So right now we're kind of sitting back. We're remaining still cautious. Our models still remain on defense. But on the upside, we're looking for more and more stocks to start rising. And that's one of the signals that will help us give us more confidence that we can start seeing stocks and the indices themselves maybe have a year-end rally. So not saying which way we'll end up going, if we'll see that happen or not, but we always keep our eyes open and we keep an open mind to different possibilities. And that's just kind of a look at one of the lenses we're looking at for hopefully if stocks can start to recover.
Yeah, hopefully. And Andrew, as always, I've got no doubt that when it does turn, and it will eventually, whenever that time period is, you'll be there to tell us and we'll be ready. And thankfully, we'll have a lot of dry powder and ammunition to take advantage of that. In the meantime, we're just going to be patient and watch and see how we develop. Hey, thank you all for giving us this few minutes of your time. Don't forget, if you haven't seen us for a while, or if you'd like to schedule an appointment with us, give us a call, 800-928-4001, or scan the QR code and do it digitally. Either way, come in and talk to us for your complimentary meeting, and we'd be happy to see you. Thanks again, everyone. Have a great weekend.